Well, holy smokes, there's a chance China could just be collapsing in front of our eyes, at least economically. And don't use my words here for it, just look at some of these previews here. China shutters more than 1 million restaurants as economy withers. Okay, that's just one of them. And these are characterizations that are popping up everywhere. They're just getting worse and worse and worse. Here's one from the Times where they say, why is it so hard for China to fix its ailing economy? A real estate collapse has many consumers cautious and businesses wary as China confronts a crisis unlike any other since it opened its economy to the world. Now keep in mind, they opened their economy to the world 40 years ago. So in other words, this is potentially the worst economic crisis in China in 40 years. I mean, consider this as well. China's real estate stocks, you thought it was bad when the companies started plummeting and tanking back in 21 and 22. Oh, no, 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 no. The problem has just gotten worse and worse and worse. Look at that. You had some enthusiasm, crash. You had enthusiasm, crash. You had enthusiasm, crash. Every dip has just been followed by more and more pain. The real estate crisis in China is now worse than what we saw in 2008, which is insane because that was a real estate-led catastrophe, a global financial crisis. So what the heck is going on? And what is all of this pain going to mean for America? And I think that's really what's important to look at here, because one of the things that you're getting is almost on a daily basis, I'm seeing article after article after article about how China is falling apart. Not just those that you just saw, but even what China is known for, their manufacturing industry going broke. And now overcapacity is leading to soaring bankruptcies. And so we have to consider, wait, what could this mean for our dollars in the United States? Kevin, just give it to us straight. Is it going to be okay? Well, let's figure it out, because it ain't going to be okay for some, but for others, yeah, maybe. Let's see which side you're on. So, first of all, China just reported some crazy deflationary figures. And the problem with deflation is that supply chains are so freaking loose after COVID that there's really no way to stimulate these supply chains because China is like a manufacturing economy. Okay, cool. So let's think about it this way for a moment. Let's say you run a factory that could make 10,000 of these. Then COVID hits, and all of a sudden there's global demand for 20,000 of these over that same period of time. And you're like, I need more manufacturing space. So you build an add-on to your manufacturing facility, you buy more machinery, you hire more people. Now you're like, all right, it's 2024. We're ready to make 20,000 cups, over what period of time? Call it a month. And now all of a sudden you look at orders, and the orders coming in aren't 10,000, 15,000, 20,000. No, none of those. They're like 2,000. And you're like, bro, I just expanded and overbuilt. Yo, government. Let me get on my China device and go, yo, government, please bail me out. I need some help. Okay, so the government's like, oh, we should bail him out. And so what do? Here's some money so you could expand your factory and create more jobs. So then you go expand your factory and hire more people, and you're like, all right, government, I have done the deed. I have expanded capacity even more. Now, instead of being able to manufacture 20,000 mugs, I can do 30,000. And the government's like, oh, that means you can do it even cheaper, which in other words continues what's now being referred to as the deflationary doom loop in China. In other words, because you have a manufacturing country, when the government, the Communist Party of China, decides to stimulate, all they're really doing is creating more deflation. So this is like a horrible loop that they're in, to the point now where, listen to this, we're now expecting the fifth quarter in a row of deflation in China on a GDP factor based on the last inflation reads that we just got. And one of the biggest drivers of deflation that you're seeing in China is a big warning to America. It's wage deflation. See, incomes have been sagging so much in China because as soon as those manufacturers say, crap, we got too much machinery, we got too much capacity here, the first thing they do is lay off. And then what happens is people start panicking because they're like, bro, I need to pay my mortgage or I need to pay my rent or whatever. So they offer their labor services for a fraction of what they were willing to earn previously just to be able to have some form of income. Wage deflation perpetuates this deflationary snowball. Then you get households that spend less because they expect prices to continue to fall. Corporate revenues fall, more corporate layoffs. Companies start going bankrupt because more people then, when there are layoffs, spend even less. Now you have salaries that are literally down 10% since August of 2022. Think about that. Like, people's pay went up like crazy during the pandemic, or at least a lot of people's. Hopefully yours was included in that. If not, hey, we'll consult with you over at stockhack.com to make sure you can make some more money. Go check out our financial advisory wealth business service at stockhack.com. We're opening up October 1st. It's going to be amazing. But anyway, in a survey of over 300 executives in China, the survey results showed the weakest growth in labor costs since COVID. And now people are starting to refer to what's happening in China as, oh my gosh, this is going to be like Japan. You remember what happened to Japan? Let me just put it this way. You know how people are like, oh, buy the dip on the S&P 500 and don't worry about it? Like, all the macro news and all that stuff doesn't matter. Okay, well, let's Google the Nikkei 225. This is the Tokyo Stock Exchange average of, 225 of their largest securities. And so what do you end up with? Oh, okay, all right, what's the 1 year return? Oh, 11%, that's great. That seems a lot like, what you'd get in the S&P 500. Oh, okay, all right, fine. What about the 5 year? Oh, it's up 64%. Kevin, what are you complaining about? Okay, well, let's go out to Max, and let's look at 1989. In 1989, which is, think about this. This is like 33 years ago, more than that. It's like 35 years ago. 35 years ago, folks. 35 years ago, the stock market, the Nikkei 225, was higher than it is today. So if you bought the dip in 1989, you might just now be break even. It's crazy. So anyway, now think about that. In the meantime, like, if people are making this comparison that China could turn into Japan, then this is really bad. Like, what's next? Well, the first thing that's next is that China starts trying to prevent economists from talking about deflation. This actually started happening. I think it was the Financial Times deflation economist China. I'm pretty sure if you look that up, you will find that the Financial Times reported that China told economists, whatever you do not report on negative news like deflation. We want you to avoid talking about that. Now, that's really interesting because I then looked at what The Economist had to say about that. And The Economist suggested, wait a minute. If we start trying to control the narrative, then what'll end up happening is we'll end up like the Soviet Union, where at first you can lie to people. At first you could tell them the data is good when it's not. Oh yeah, GDP is 4% when you're lying through your teeth and you know it's not. But what happens when the market is no longer able to properly react to real data? Well, the market stays propped up on Fugazi. And when the market stays propped up on Fugazi, then all of a sudden, the leaders in the country start going, see, our charade's working. And then they start going, cool, so, we're the leaders of the country. What's the real data? And all of a sudden, the economists are like, we don't know because you lied about some of the original data, so we don't know what we're comparing to. And then all of a sudden, the bottom falls out, and you're like, why did Soviet Union collapse? Well, that's one of the reasons. All of a sudden, wow, when you take control of an entire economy via authoritarian means, what a surprise, it all collapses. Here it is, Financial Times, August of last year is when they started doing this. Chinese authorities are putting pressure on prominent local economists to avoid discussing negative trends such as deflation, as concerns mount about Beijing's ability to boost a flagging recovery in the world's second biggest economy. Oopsies. Well, guess what? Covering it up didn't work. And now you have the weakest core CPI in 3 years. And now you literally have a former central bank governor of the Chinese Communist Party. Say that's the People's Bank of China, saying, rooting out deflation has become a top priority. Oh, so now y'all are starting to admit you made a little oopsie doopsies. Remember back in the day, China gave, during COVID, China gave like $500 of consumer stimulus to consumers, while the United States provided the equivalent of like $5,500 to $6,000, so like 10x the stimulus. China doesn't stimulate their consumers, they stimulate their job providers. But that just leads to more deflation and probably malinvestment by keeping bankrupt manufacturers open. Now, on one hand, it's probably good for manufacturing costs to go down, but there is that deflationary doom loop you have to consider. So let's think for a moment about the good. The good is that maybe if manufacturers are competing for more work, it's now cheaper for Apple to manufacture in China. It's now cheaper for Tesla to manufacture in China. Great. If it's cheaper to manufacture there, you could build cars there or build phones there, export them to other countries, and great. You don't have to go to India or, Taiwan or some other country. Just do it in China because it's gotten so freaking cheap to do it there. This whole idea that, deglobalization is going to cause inflation. Bullcrap. I've been saying it for years. Re-globalization, and it'll be even cheaper than it was before because you'll face deflation. That's exactly what you've got right now because the Financial Times calls demand lackluster. Oh, it's much more than lackluster. Confidence in China's economy is crushing China to the point where consumer confidence is at the same levels that we saw when COVID hit and stayed down during the entire real estate crisis. You haven't seen any heartbeat over here. It's like a flat line. It's bad. Foreign companies call China's policymaking unpredictable, unfair, or uninvestable, per The Economist. Foreign direct investment in China is at the worst level on record, down at least 30% year over year in just the first 7 months of 2024, and declining, and it's already been declining. It's pretty bad. And some policymakers in China say China has just killed long-term confidence on China. Now, some say, well, China's at least trying to loosen laws for entrepreneurs to try to stir up demand, but they could just flip-flop again. Remember what they did during the COVID lockdowns? Lockdown. Hey, everybody can go open. Everything's fine. Oh, no. That kind of stuff can happen with regulations as well. In fact, some say that's what started the real estate crisis in China. You had this incentive from the government to just keep building real estate, whether it was profitable or not. So companies were taking on debt on debt on debt on debt. They were selling properties that weren't built yet. And so you were getting these poorly built properties because they were already sold. The builders didn't really have an incentive anymore to do a great job. And then all of a sudden China's like, we don't like how much debt y'all have. Cranks them down with the 3 red lines policy. And oh my gosh, we created a real estate collapse? What? Yeah, wow, China, messing with your free market. Oh, what free market? Anyway, so how could potentially a depression, a deflationary recession, or whatever you want to call it, whatever it ends up being, affect America? Well, think about this. First of all, if it gets so bad, initially we think, this could be good for manufacturers because you can make things cheaper, which basically means if you have deflation in China, you're actually probably exporting deflation to America. So you have more deflation here because our import prices are lower. This is good. If you have a recession in China, you might also have commodity prices decline, which if you look at the BCOM index, which is just the Bloomberg Commodities Index for, what's going on with commodity prices. If you go year to date, dude, rock frickin' bottom year to date. We're at the lowest level of commodity prices year to date, lowest level in the last 1 year. And quite frankly, we're at the lowest level of commodity prices since about August of 2021. So this either signals that you're going into a recession, or it signals that China's in a frickin' recession, or worse, both. So Now, again, commodities could be a good thing. In other words, commodity prices coming down, oil prices go down, gas is cheaper for us in America, which hopefully stimulates consumer demand in America. Hopefully, you get, lower costs of goods sold, again, at companies like Tesla. But what happens when those factories just still can't make a buck in China and they go bankrupt? Well, now all of a sudden you could actually, instead of having really loose supply chains, you can tighten supply chains again. Basically, what you open up the risk to is some form of a black swan. Now, I'm not trying to doomsday here, suggest that there's definitely going to be a black swan, but when you have this sort of crises of companies going bankrupt in China, there's a possibility that these Chinese companies have to dump whatever assets they have. Those could be American-based assets like treasuries, stocks, various corporate bonds, you name it. You could get even more of a liquidity crisis. Companies or businesses that made investments in China lose money there, so they have to free up money elsewhere. Could be bad for crypto assets across the board. It doesn't really matter what it is. People are trying to get out of China. But this also creates an issue because the people who are still trying to hang on, like the business owners or the companies or the executives that have assets elsewhere, might have to dump those. So pain in China can be felt and ripple throughout the entire world. Again, we don't want a black swan to happen, but it can. And China could be what causes it. Now, it's unlikely to be a carry trade style speculative crash like we had with the Japanese yen. Here you have the yuan, also the renminbi as the currency system. The black swans, though, not just market volatility, which you can get from these companies dumping, less again the carry trade, I think, still a possibility though, supply chains failing, but you could also just get debt failures and cascading debt failures. So when companies that owe money can't make their payments anymore because they're going bankrupt, now all of a sudden certain financial institutions that were lenders could go BK and that could trickle over. It's very complicated to say exactly who gets hit, but here's some examples of companies that have a lot of money coming from China. And these are just some examples. You could generally look at this yourself and evaluate for yourself how companies you might be investing in are exposed. But I think it's very interesting to know that 22.7% of Tesla's revenue in 2023 came from the Chinese market. So yes, it's nice to have cheaper manufacturing ability in China, but if you're also in a position where, nearly a quarter of your revenue is coming from China, that's not as great. Now, Nvidia used to have about a quarter of its revenue coming from China, but that's now substantially declined because of the AI rush and export control restrictions limiting a lot of their exports to China, at least for the greatest chips. They go through other countries now and get black market smuggled. 18.9% of Apple revenues come from China, and 8% of Starbucks revenue comes from China, but 30% of their stores are in China. That's because over the last 3 or 4 years, they made a big bet on doubling the number of stores they have in China, thinking that they'd be able to sell Starbucks American coffee in China. But with 1 million restaurants going bankrupt in China so far just in 2024, people are like, oh, no, I'm not buying Starbucks. I'm going to go buy Luckin Coffee or something cheaper in China. Why buy Starbucks American brand when you could get it for a fraction of the cost? It's just freaking coffee, and the Starbucks coffee ain't that good anyway, when you could get that somewhere else. Now, I know they're trying to shove the Chipotle CEO in over there, but good luck. That's all I got to say about that one. Nike's got about 15% of their revenue in China. Caterpillar about 5 to 10% of their revenue in China. Maybe more. They're a little less clear in it. But usually you could just find this information in the annual reports for these companies. So I'm a little bit nervous about China, and I'm tempted to decrease my exposure to Chinese markets, broadly, because I can't bet. I've said for years, I'm not going to bet on the Chinese consumer. I don't know China that well, but what I do know is, based on what we're seeing, even coming from China now, is that it's probably a lot worse than we think. And I'm not going to be the person to speculate that the hints that we're getting that it's worse than we think are wrong and it's actually better than we think. So I'm going to stay away from the China place. Now, again, I feel bad because, I think Baba is selling at a huge discount. Maybe it's already priced in a lot of that pain. It's a very inexpensive company. But that's only assuming that its growth holds up based on the lie of the Chinese data that we might be getting. What if the Chinese data is so wrong that we're getting that the growth numbers are actually way worse for GDP and therefore future growth expectations for Alibaba and so JD or whatever, some of these other companies are actually way worse, Temu's and the others. I mean, we already saw some of the reports come out, like Temu was a freaking disaster. What happens at that point when the real data comes out and people are like, oh my gosh, we've been misled. These aren't companies that are actually growing, they're actually shrinking. I mean, you here, I'll open up the week chart here really quickly on the company working Temu. It's still not at a low here, but look at this decline you just recently had here. I mean, you just recently went from $150 down to 92, and that's just because some of the data is starting to show up in earnings. Well, what happens when all of the data of this pain shows up? Are these going to be even lower, like what we saw in the 2022 stock market sell-off in America, except now with real Chinese data? Who knows? But they're things that I'm watching. Anyway, these are my thoughts. If you have questions about how to position your portfolio and get actual financial advice, make sure to check out stockhack.com. We are offering real financial advice and consulting. It's flat fee. It's not like we're gonna bill you every 15 minutes that you're talking with our financial advisors. This is my office, my staff, and I talk to my team about everyone's scenarios, and we're working together to make sure that you've got a balanced portfolio, whether it's balancing stocks and real estate, stocks, bonds, and real estate. You're trying to figure out how to position your family for retirement or wealth. Make sure you get a licensed financial advisor on your team. Learn more over at stockhack.com. We're launching that service come October 1st. And hopefully you'll be able to hear from us a little bit before that as well. Thanks so much for watching the video. We'll see you in the next one. Goodbye, folks, and good luck.
These things that you told us here, I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.